So I'm going to cover very briefly a point just tying back to Andrew's topic of gift aid and how there's supported VAT points when you're looking at retail gift aid. Then I'm going to stay on the theme of donated goods because we've got some consultation documents from HM Revenue and Customs on how we treat donations of goods. And then we're going to talk about some proposed changes on the capital goods scheme, which if you haven't heard about before, you will know about it by the time you leave today. And then a little bit about where HMRC are focusing their attention at the moment, bearing in mind that they are on a revenue-raising mission. So first of all, and very briefly, the Retail Gift Aid Scheme enables a charity to claim gift aid on the donation of goods to that charity. Where those goods are then going to be sold, the charity can then claim gift aid relief. What we need to keep in mind, though, is that the charity or its subsidiary has to enter an agreement with the donor. The donor walks into the charity shop, hands over a box of their deceased father's LPs, this was me a few weeks ago, and says, you can sell these on my behalf and keep the proceeds. That's how the Retail Gift Aid Scheme works. In effect, the charity or its subsidiary is then agreeing to sell that for you. So they have to charge a small commission for that service of selling your box of LPs on your behalf. VAT has to be accounted for on that commission if you're VAT registered, so don't forget that. HMRC say the commission should be between 2 and 5% of the value of the donated items. And then the amount that gift aid can be claimed on is the value of the donated items less the commission that's being charged that the charity or the subsidiary is going to keep, and the net proceeds there is what gift aid can be claimed on. Now, if you don't charge the commission, HMRC could potentially say that you have actually got a non-business activity going on because you're providing a service of selling the box of LPs for no return. You're not generating any income from that. And we'll come back at the end to why not business matters so much from a VAT perspective. Keeping on the theme of donations, hopefully you're all aware that goods that are donated to a charity, where the charity is going to sell, hire or export those goods, can be zero rated by the donor. So zero rating means they don't have to account for VAT, but they can still claim all the VAT back that they incurred on the cost. So it's the golden ticket zero rating in VAT world. Then the charity, when they subsequently sell those donated items on, can also zero rate that sale. So again, golden ticket. They don't have to charge VAT, doesn't restrict their VAT recovery or their costs, provided all four of those conditions are met. The potential problem that we have is that one of the conditions is that the charity has not used the goods themselves. So if you are a business, you donate goods to a charity, they're not going to be sold or exported or hired, but in fact the charity is going to use those goods themselves. So you might be generously donating them some laptops that you don't use anymore in your business. Then the business has got to account for VAT on that donation at 20%, probably. If the charity then sells those items on later, it would also have to account for VAT at 20%. So this is a problem. And I think the real problem is actually that most people don't know about this. So nobody is accounting for VAT on those sorts of donations. If they're thinking it's a donation, they're doing something lovely, they're giving something to charity, and they don't need to worry about VAT. But no. So HMRC are wanting to simplify this. We all know that that's a red flag when HMRC plans to simplify anything. They've issued a consultation. Now, this is the plethora of questions that they're expecting consultation responses to address. I have picked out the ones that I think are most relevant. What they're saying is, we're going to propose that in that scenario where a business makes a donation of goods to a charity, even if the charity is going to use those laptops, in my example, for its own purposes, or indeed give those laptops free to its beneficiaries, the business can still zero rate that donation. So they don't have to account for the VAT that they probably weren't accounting for anyway, but nevertheless, it's going to regularise things. So they're introducing this relief. Every time we get a relief, we get conditions that come with it. And conditions bring complexity. And complexity brings potential areas of argument and debate and litigation in the future. It's clear to me that HMRC are looking to restrict the types of donations that can be made to charities, because they're asking us, what sorts of goods do you think we should be able to zero rate? They're not saying you can zero rate everything that we choose to give to a charity for its own use or for it to distribute free of charge to beneficiaries. So there's no doubt going to be arguments about what's on that list, whether what you've donated falls into those narrow requirements or up in the future. They're also asking about whether the charity itself is going to have to somehow certificate or guarantee or confirm that the items that it's giving away free of charge are to qualifying beneficiaries. So that might be people who receive welfare support. So the layers of admin are just growing and growing here. So we will be considering whether to respond to this consultation. I would encourage you, if this is something that might impact you, to feedback your thoughts to me or to one of your contacts at Larkin Down as well, so we can bear that in mind. Capital goods scheme. This little change was slipped out last month by HM Revenue and Customs. The capital goods scheme thresholds apply when you are spending money on land and buildings. That might be building, that might be renovating, that might be extending, refurbishing, or on computer equipment largely. And what they require you to do is to recover the VAT at the point you incur that spend, as you can. And then for the next 10 years, when you're talking about land and property, revisit how you're using that asset every year. And if the level of your VAT recovery increases, you can claim back some more VAT. But if it decreases, you have to pay some back to HM Revenue Customs. So it's another sort of admin task for you to manage, but also it can have actual sort of cash implications for you where you have an asset. So normally land and buildings are only above once, computer that's 50,000 or more. It's a single computer. That you suddenly change how you're going to use it. Now, 10 years is quite a long time. We're sitting today thinking I'm going to use this lovely shiny new building and I'm going to have 80% taxable use for VAT purposes, so I can recover 80% of my VAT. In 7 years' time, your strategy might have changed. You might not need that building anymore, and suddenly you're looking potentially at having to repay some of the VAT that you recovered 7 years ago. Those levels of 250,000 and 50,000 have not changed since 1990. So this is yet another example of the stealth tax that was mentioned previously. So with the suggestion now is that land and property limit will be £600,000 net of VAT. And that computers will be removed entirely because they've now become much more commoditised and not that sort of level of spend at all. We don't know when this will come in. We don't know how it will transition to the current rules. But my expectation is that it will just be when you start using an asset that meets that 600,000, then you'll be in the new rules. And everything that we've currently got, so the old rules will stay there. But that's just me guessing. Why does it matter for you? So if you're no longer looking at a £250,000 spend, which frankly for land and property doesn't get you very much, does it? We're now talking about 600,000. It may well be that you don't have to worry about the capital goods scheme at all. You don't have that admin to worry. So brilliant news. If you're not in the capital goods scheme, or that property is not in the capital goods scheme, and you then sell it within its 10-year capital goods scheme life, the risk of having a VAT clawback on that sale is gone, because it's not a capital goods scheme item. You're not having to go back and say, well, how much VAT did I originally recover? Do I now need to repay it? However, what it does mean, if we have a building that's not in the capital goods scheme, is that your VAT recovery on that cost is fixed at your first point of use. So if my hypothetical new building that I recovered 80% of my VAT on, suddenly at some point during that 10-year period, I start using it for 100% taxable use, I can't claim that extra 20% of the VAT if it's not in the capital goods scheme. I can only claim that extra if my assets in the capital goods scheme, and fewer assets are going to be in the capital goods scheme because of this uplift in the threshold. That's a potential downside. Now, we know that, for example, independent schools who've recently had to VAT register have seen some benefit from being in the capital goods scheme, because they've been able to look back at their spend over the last 10 years and recover some VAT that they previously couldn't. So although it's generally seen as a bad thing, there are occasions when actually the capital goods scheme is useful. I mentioned HMRC on a revenue raising programme at the moment. So I'm just going to talk about a couple of sort of areas of interest that they're focusing on right now. So first concerns the fundraising exemption. So charities can exempt admissions income from fundraising events subject to those criteria being met. HM Revenue and Customs took a case against the Yorkshire Agricultural Society, so similar to Royal North Yorkshire Ag and Suffolk Ag associations who run the Great Yorkshire Show. They had treated the income from the Great Yorkshire Show as VAT exempt under the VAT fundraising exemption. HMRC said, no, it's not exempt because it's not actually primarily to fundraise. It's primarily to educate people who are attending the show. They lost at the first tier tribunal. Quite unusually for HMRC, they then appealed to the upper tier. Normally, if they lose, they leave it because they don't want to create binding precedent if they take it any further through the court system. They did appeal to the upper tribunal and they lost again. So we now are in a situation where we're expecting HMRC to, they normally issue a business brief in these scenarios to clarify how they're going to take that treatment forward. But we can have dual purposes for a fundraising event and still claim the VAT exemption on the admission income if we want to. The other area where we're seeing a lot of HMRC intention at the moment is on non-business activities. So earlier this year, HM Revenue and Customs issued one of their one-to-many letters. So where they send one standard template letter to many recipients. And these are normally where they've got a little campaign where they think there's a risk and they're trying to encourage taxpayers to do the right thing and to get their tax affairs in order. They sent these one-to-many letters to smaller charities, asking them to make sure that they knew whether they had any non-business activities. If they had non-business activities, they wouldn't be able to recover all of their VAT. They'd have to do some kind of restriction on the amount of VAT they can recover. Now, non-business is a very complicated concept in the VAT world. But broadly, it's doing stuff for free. If you do stuff for free, you've probably got non-business activities. And that means you can't recover all of your VAT. They are particularly, at the moment, attacking sports clubs and querying whether they have got any non-business activities that can't recover all of their VAT if they're VAT registered. But also we're seeing them tackling other sports clubs saying, oh no, you should be VAT registered because everything you do is business. So one way or the other, they're going to have a go at it. If you're in the sports club area or have any dealings with sports clubs, just keep in mind Things like the fundraising exemption. If you're holding events, you can exempt your admissions income. If you don't want to treat that as exempt, you might want to be VAT registered, you can opt to tax your sports club hall, and that means you charge VAT on all of your hiring income. That might be attractive if there's lots of VAT you've incurred that you want to recover. Think about business, non-business, because if you don't, HM Revenue and Customs will be thinking about it for you. Remember that if you receive sponsorship income, that need be taxable for VAT purposes, so might then tip you over the registration threshold. Don't forget partial exemption. I feel like that might be on my tombstone. Don't forget partial exemption. So that's it for me. Any questions on VAT before I hand back to Giles? I'm hanging around if you want to come and speak to me.